What if I told you that a seemingly small decision by the Federal Reserve today could dictate whether our economy sails smoothly to safer shores or takes a dangerous dive into recession? That's right. The Fed just dropped interest rates by 0.25%. Now, I know that sounds minor, but trust me, this is a huge red flag that something major is brewing behind closed doors. With inflation still running higher than desired, unemployment beginning to creep up, and the Fed subtly acknowledging that our economic stability might be more fragile than we've been led to believe. It's time to pay attention. Welcome back to BrainFuel Reads. In today's episode of our What If series, we're peeling back the layers on this rate cut to understand what it really means for all of us. For markets, for the dollar, and for your hard-earned money. Stick around, because by the time we wrap up, you'll be equipped to determine if this is a promising step towards stability, or just the calm before a storm that could shake things up. So, what exactly just happened? On September 17th, the Federal Reserve made headlines by cutting its benchmark interest rate by 0.25 percentage point, landing it in the range of 400 to 4.25%. It might feel like a small tweak, but this marks the first rate cut since December and signals a significant shift in strategy. For almost 2 years, the Fed's main goal was to combat inflation. They kept rates high to cool off spending and rein in prices. But now, the narrative is shifting. Inflation has eased enough to offer them some breathing room, and their focus is expanding. They're starting to worry about a slowing economy, the job market losing steam, and the looming risk of pushing the US into recession. Markets were bracing for this move, so the announcement didn't come as a shock. Stocks nudged upward, bond yields dipped, and gold, as always, kept a vigilant eye on the situation. But the real story here isn't just the rate cut itself. It's about the why behind this decision and the potential fallout that could follow. Remember, a rate cut is never just a rate cut. It's a signal. And if you know how to interpret that signal, you can get a clearer picture of where the economy, and perhaps your portfolio, may be headed. So, why did the Fed decide to cut rates now? First off, we've got the job market. After holding strong for a while, it's starting to show some cracks. Hiring has slowed down a bit, and we're seeing some layoffs in key sectors. Unemployment is still low compared to historical standards, but it's not the super low we experienced like last year. The Fed is acutely aware of this. They know the job market has a tendency to lag. By the time it looks bad on paper, it might already be too late to avoid serious damage. Then there's inflation. While it's still hanging above the Fed's 2% target, it has been slowly drifting down. The core inflation measure, the one they really keep a close eye on, finally seems to be under control. That shift gave the Fed a little breathing room to make a cut without completely risking a surge in prices. Now let's keep it real. There's also market pressure at play. Investors have been pushing for these cuts for months, fearing that high borrowing costs could derail growth and lead us straight into recession. This rate cut gives them a little relief, at least for the moment, while also creating some goodwill toward the Fed. It's a signal that they might consider more cuts as the year goes on. But it's not just a domestic issue. The global economy is feeling the strain as well. Europe is flirting with recession, and China's growth isn't hitting expectations. Factor in trade tensions, rising tariffs, and ongoing geopolitical risks, and it becomes clear why the Fed felt the need to act before things potentially spiraled further. Here's the kicker. A cut like this sends two very different messages. On one hand, it can convey confidence that the Fed believes they can guide the economy to a smooth landing. On the flip side, it can also raise concerns, suggesting they might see trouble on the horizon that we aren't fully aware of yet. And that's why this decision matters so much. When the Fed makes a move, you can bet there's a purpose behind it. They're sending a message. Right now, that message is pretty clear. The balance of risks has shifted. For nearly 2 years, they have been laser-focused on tackling inflation, raising rates relentlessly regardless of how much the markets complained. But with this cut, they're essentially signaling that the economy can't bear that kind of pressure any longer. This cut suggests growth is slowing more quickly than many realize. And if they don't act, we could see unemployment rise even further. It also shows they are willing to gamble a bit with inflation to prevent the economy from hitting a wall. And here's the interesting part. Every rate cut has two faces. For some investors, it's like a green light to take on more risk. After all, stocks usually thrive on cheaper money. But for others, it's a red flag that the Fed is picking up on some underlying troubles and is sounding the alarm. In short, this cut isn't just a shift in policy. It's a test. A test to see if the Fed can navigate us toward a smooth landing, or if this is the first domino in a chain reaction that might lead to a recession. So, what do you think will happen next? In the immediate future, the markets will likely process this recent decision, and traders are already making bets on what's to come. Some are even anticipating not just this rate cut, but the possibility of 2 more before the year's end. If that unfolds, we could see borrowing costs drop significantly in the next 6 months, which is fantastic news for anyone carrying debt. It could also give a boost to stocks, housing, and maybe even crypto. But hold on a second, there's another side to this story. If inflation decides to rear its head again, think surging energy prices or rapidly rising wages. The Fed might have to hit the brakes on these cuts. That could send shockwaves through the markets, causing stocks to dip as investors scramble to readjust their expectations. And then there's the looming recession risk. If growth continues to stall despite this cut, we might find ourselves facing a series of deeper cuts in 2026. Not to encourage growth, but to stave off a potential economic slump. That's a sticky situation, and nobody wants that happen. Because once the Fed goes into emergency mode, market volatility can skyrocket. This is why the next 3 months are absolutely vital. Every jobs report, inflation update, and speech from Fed Chair Jerome Powell will be under intense scrutiny. Each of these events could drastically sway the markets. So, what's the takeaway for you? First and foremost, don't panic. This is one of those moments where long-term vision really sets apart the winners from the rest. Rate cuts can present some incredible opportunities, if you know where to look. If you've got debt, be it a mortgage, a student loan, or a business loan, now might be the perfect time to think about refinancing or locking in lower rates before the market shifts again. Those lower rates could mean more cash in your pocket if you play it smart. For investors, now is the moment to take a fine-tooth comb to your portfolio. High-growth stocks and sectors that benefit from cheaper money may thrive with more cuts, but it's also wise to keep a hedge in defensive assets should the winds turn. This is where safe havens like gold come into play. They typically outperform when things get choppy. And perhaps the most crucial piece of advice, stay alert. The upcoming months are going to be pivotal. Will we glide smoothly toward a soft landing, or is turbulence on the horizon? Those who are prepared will be the ones who can weather any storm and even grow their wealth in uncertain times. So here's the question I want to leave you with. Do you think this cut is the start of something bigger, a turning point for the economy, or just a one-off move before the Fed holds steady again? Let me know your thoughts in the comments. I read every single one and love seeing where you stand. If this breakdown helped you make sense of the markets, hit that like button, share this with anyone who's feeling uneasy about the economy's path, and don't forget to subscribe so you never miss an episode of BrainFuel Reads. The Fed has made its move. Now it's our turn to interpret the signals. Prepare and stay ahead of what's coming next. Until next time, keep your curiosity alive, stay ready, and as always, keep your brain fueled.